The stock market recently broke to new highs, as you can see here, but now is it actually losing steam? Well, it's time to hit our weekly market review to answer that question. So of course we're going to figure out where stocks are going, but there's also a few other opportunities in the market that we'll go over as well. Because you know I love to give you more than what you're looking for or asking for. And yes, I had to bring the puppy, Luna. I don't know if you could see her, she kind of blends in with the chair, but you guys were complaining about the crying in the last video. She was upstairs, but you could still hear it because this mic is just way too sensitive. So now instead of crying, you could watch her back there and hear her constant chewing on her toys. So sorry in advance. Now the first thing we want to look at to evaluate this market is actual buybacks. And these are company buybacks. What corporations do is when they have extra cash, they buy back their shares in the open market. Now these are corporate buybacks. So what companies do when they have extra cash is they buy back their own stock. And the whole puppy and chair idea is already breaking down, but let's continue. So this whole corporate buybacks has been rocket fuel to the market, and it has been propelling the stock market higher since 2009 because there's been so much easy money floating around that these corporations are able to get their hands on it and then use it to buy their own shares. And why did they do this? Well, executive compensation is usually tied to the stock price of the company. So if you buy your own shares, then what's happening? Less shares on the market, and there's also buying pressure pushing the stock price higher, which is better for the executives. They're going to get paid more. So there's a huge incentive to buy back shares in the market. Helps the executives, and if we're invested in the companies, it helps us too. And overall, it's so frequent that the whole stock market is propped up by it. And now the puppy's off eating peanut butter. But okay, going back to this chart, this is important because we want to see more buybacks. Whether you think it's right or not in the sense of corporate governance, well, we want to see it for stock prices. And this year was the first year since 2009 where net share issuance was flat or positive. And net share issuance means how many shares are they releasing, new shares into the market, versus how many are they buying back. And that affects the number of shares that are out in the market, which is called the float. So buybacks have been down a lot this year, 54%. And you can imagine why, because of, the whole CCPV pandemic. And not only that, but companies have been issuing shares like crazy to shore up their balance sheets, because what happens is they release new shares in the market and they collect all that money. Biggest examples you saw was like Tesla this year. They released shares and somehow the stock price still shoots up because there's just so much demand for it. So considering that you can see right here, it's flat in 2020. This green is the corporate buying and this blue is new offerings. You see they're pretty much equal. So the fact that they're flat and there's not more corporate buying than new offerings like you see in every other year here, with the green bar much bigger than the blue, the fact that the market is holding up is pretty good. And this bodes well for 2021 when these cash flush companies are expected to more than double their share repurchases, because now they've been saving up all this cash during this pandemic and they're ready to deploy it again because these executives, they want to get paid. They want their stock options to go higher and higher. So when the stock market is doing this well in a year where we barely have buybacks, can you imagine when the buybacks come in? This is a really bullish sign. And an important concept to understand here is the idea of supply and demand. You don't always think about it when it comes to the stock market because, you try to think that things are way more complicated, but no. When you cut out all the BS, it always comes down to supply and demand, which is why I'm saying a lot of demand from these companies for their own shares and they're buying it back and reducing the supply. What's going to happen? Prices should shoot up. Basic economics, right? More demand than supply, prices go up. See that with the PlayStation 5 right now. Nobody can get one and they're trying to buy them on eBay. So you pay a bunch of money over the retail price because there's no supply and you get sent a cement block. Yeah, people are getting all sorts of junk in what is supposed to be a PlayStation box. Scams. There's so little supply that people in the United Kingdom are robbing trucks, moving trucks and grabbing PlayStation 5s off of them. It's like Fast and Furious style. And all of this just pushes the price for the PlayStation 5s, at least on eBay and secondary marketplaces, which the stock market is a secondary marketplace for stocks though, of course, but it's pushing that price higher and higher. So that's the same way you got to look at the stock market. By the way, anybody else excited for Cyberpunk to come out in a few days? I am. They say the best way to cure your depression is to jump into a virtual world and become a robot android thing. Or I guess this is technically a cyborg, right? And before you know it, you're just plugged into the Matrix and happy like Cypher. Look at that smile. That's what we all want to be, don't we? Moving on, the NYSE McClellan Summation Index surpassed 900 for the first time since August. And what does that mean? Well, I'm going to tell you. Basically, this summation index is a breadth indicator for the stock market. And what is breadth? Breadth is how many stocks are going up versus how many stocks are going down. So to have a healthy stock market, you want a lot of stocks going up together because there's multiple stocks that make up the market, right? Versus what could happen is a few big stocks, like say Apple, are going going up while everything else is falling. But those stocks are so big, the bigger ones, that they're propping up the entire market. So it's not healthy. There's too many holes in the market. When everything is going up together, though, that's strong. That gives more of a probability that the market will continue higher. So it's a breadth indicator, this McClellan thing. You don't have to worry about it more than that, but it surpassed 900 for the first time since August. And S&P 500 forward returns following this reading above 900 leads to consistently good returns over most time frames. Basically saying when this indicator passes this point, that usually means good returns in the future for the stock market. And I'm going to tell you right now, we do these videos every week. We talk about a lot of indicators, but just don't get caught up in the indicators. So if the stock market goes down going into Christmas and the new year, don't come back and say, oh, but McClellan, the McClellan indicator. I could barely say McClellan. But at the end of the day, screw McClellan. It's just context for a broader picture. Don't get attached to any one indicator. Just focus on sticking to your strategy, which we'll talk about more in a second. An interesting thing we've been seeing in the market lately are small caps. They've been taking off like no other. And at this point, they're extremely extended from their 200-day moving average. And what does that really mean? Well, like I always say, technical analysis and moving averages, they're not magic. What you're really trying to gauge here is how far away are prices from their standard level. You're looking at standard deviations because markets mean revert. They revert back to the average a lot of the times. So when something gets extended past that average, oftentimes it'll come back to it. And of course, by the time it's extended, that average will be a little higher, but it will still come down. Things don't go straight up, or if they do, it's only for a period of time, a short period of time, most likely. So when we see something extremely extended from its 200-day moving average, there's a few ways to think about it. You can go back and see how the thing reacted in the past. And there's only been 2 other times the index was this extended over the last 40 years, and it happened to mark a major top. So that's one way to look at it if you look at it down here. But also, this current extension that we're looking at followed a severe extension under the moving average. And it's much more like 2009 instead of 2000, meaning that this probably isn't a big top. 2009 was a bottom, 2000 was the top. So that's another thing, like I was just explaining, right? Markets and prices revert to a mean. So if something goes way below a mean, it will spring back up to the center once again. And a lot of times it'll even overcorrect. If it went too far this way, then it'll shoot back up too far the other way and then come back to average. That's what might be happening now. And I say all this stuff because it helps to know how market prices move. You start developing that experience, and then over time, you kind of understand what's going on. You get a feel for the tape, as they say. You get a feel for the prices. Now, this whole thing with the small caps reminds me of something really important that I'm going to tell you, a story. So you're going to want to listen. So in our strategy, which I always talk about, our Fallible strategy that I myself use and most of our Fallible community uses, we took a bad loss recently. When I say bad loss, I don't mean it actually hurt our portfolio. We're still up 55% this year, but it was bad on that specific trade itself. And I'll show you what it is. It was mRNA, Moderna. And this is a stock that we've been in and out of in our strategy, but we've been unable to really get these gains, even though it's taken off. And it's been really frustrating. And it was frustrating the first time when we got into it, which was in November. We got knocked out. I think it was November, but we basically got knocked out before the vaccine news came because we were listening to our risk control. And then the vaccine news came and the thing took off. So again, our system told us to get in on December 1st. But December 1st was not a good day because the thing took off and it was really high in the opening and then it fell hard. So of course, we got shook. So the model got in at the open, which was pretty high already, and then the price dropped and it hit our risk point. So we got out the very same day. And look what's happening now, it recovered just fine. So within a few hours, we lost a good chunk of money. So not a fun trade at all. But here's the thing, even though it wasn't a fun trade and we lost money, I'm not going to say it's a bad trade. Why? Because this is the same strategy that we've executed for years and it's made great returns. So when we look at this specific trade in Moderna, we can't say that, hey, this trade was garbage. That means the whole system is garbage and the strategy is garbage. No, that's not how it works. That's actually the trap that a lot of traders fall into. And unfortunately, it's a trap that some of our Fallible people fell into too, because they started emailing me saying, I'm not going to use this strategy anymore. It doesn't work. Which when I got those emails, of course, I try to talk them down. But this is why not everyone, stays in the market. It's because these things happen and they really shake your confidence. Like, it sucks to lose. No one likes to lose, right? Especially in a single day. And of course, what I say is all about cycles, right? This is what happens. You win, you lose. Over the long term, though, you are profitable. Now, of course, we might know this logically, but like I said, still hurts, right? Losses still hurt. So it's the people that get through those losses and keep executing their strategy. Those are the ones that are successful long term. And I'll tell you what, even when we were entering, right, I was executing the system. We got in high. I was like, oh God, this looks like a blow off top. It's probably going to kick us out real soon. And sure enough, it did. I was right. But guess what? You know how many times I've been wrong where something pops up like this and then we get in because the system says so and it keeps running, where I had that same mentality, right? Because I guess I'm too negative, but I'm like, oh God, it's going to fall. And if I didn't listen, if I didn't take those trades, my returns would be completely screwed up. Now, in this particular case, yeah, I guessed right that it would fall. But hey, look at another position that we got into, Pinduoduo. This thing gapped higher, right? And like I just said, when I see gaps, I don't necessarily like getting into them. But now it's taking off. It was up almost 8% today. Same thing though. It's like, oh, it's shooting up higher. Should I get in? Probably not. It's going to fall. But hey, the system is saying get in. I'm going to get in. Worked out in Pinduoduo, did not work out in Moderna. But again, can't look at those two trades individually. You need to look at the full cycle of hundreds and hundreds of trades. Then you'll see, oh, okay, this strategy does work. Over time, I come out ahead. That's why we're up 55% this year. So it becomes super important to be able to control your emotions and remember these things. Remember how the market works, how strategies work within the market, and keep executing. We know the strategy has an edge. We know it works over the long term. We know it has good risk control. Us getting out of Moderna, good risk control. We followed the system because guess what? It might not have rebounded. It might have collapsed. And then we'd be real happy being like, hey, we're geniuses. But any individual trade, you can't make a broad judgment off of it. That's not how strategies work. That's not how the stock market works. And when we look at the market, right here is a chart of the S&P 500 on a monthly time scale. We could see some really strong action. November ended up forming the outside up bar following an inside outside inside pattern, meaning it's a bullish breakout. So odds strongly favor a bullish continuation into year's end. If we look on the weekly time frame, the S&P cleared that 3600 resistance level we were watching. You see this red thing right here. Odds favor a bullish continuation this week, and the next measured move target is 3845 all the way up here. You can see two strong weekly bars with a close above this resistance level. That gives it a lot of strength, meaning this trend is going to probably stay up. So to answer our question from the beginning of this video, no, the stock market is not losing steam. We're looking really good going into the end of the year. And then based off those other things we were talking about, next year should be pretty good too. And going back to what happened with our strategy in particular, with Moderna, and I'm just talking about our strategy as an example, but this happens to anybody. With any strategy you're using, there's going to be losers. But the idea is to stay confident, stay in the game, because more opportunities are going to come. And you're only going to be successful and make money, grow your wealth, and all of that if you're consistently executing and if you keep going. And this is actually something that Warren Buffett talks about too. He says it's the most important thing to be successful in the stock market, this one factor. And it goes back into what you can do to control yourself and your emotions to get through periods like this or any rough period in your strategy. He explains it a lot better than I do. You should definitely watch that video. I'm going to put it right here. Watch that because I know if you have a losing trade during this period where everything is going up, you feel even worse. So click this link right here and I will see you there. Very important stuff.